I know that you can't see me right now just because I'm not sitting in the front of camera. I have been like trying multiple times to create videos and try to create good content around software development and sometimes around finance and different topics. But what is happening that whenever I do try to do this content creation thing, it takes a lot of strength out of me to create this content. But I don't have a lot of time for that. So what happens next? What can be the alternative path? Or what are the alternate options that I have actually for this one? Is that I saw one of the videos from Gary Vaynerchuk, and he talks about like documentation or documenting your journey rather than just doing your content creation, because it is better that you are putting yourself out in the world and people are knowing yours about yourself, what who the Ishan is, and here is I am. At, according to me, I am like primarily on like first I am a software developer, and then I think of myself as a guy who try to just try different things in life and figure out what is best and what is going best according to me. So, so the whole topic around this video is that I'm a like fintech developer and I work for a finance company. But what happens that I know about the tech, so that, and also there are a lot of cloud related different AI editors, AI code editors, so I can write better code or think of better architectures. That can happen. We can try different architectures very well. But what the next thing happens that we lack financial knowledge. So I thought that why not I take a topic and just read some books around that so that I understand it better and I can apply that at my like job, so that it helps me on both the cases. And creating a video helps me articulate the thoughts in a better way, and whatever I read, so that I will be able to speak it better, apply it better in my life and my job as well. So here is we generally do financial analytics for banks and lending institutions. So what happens that there's a concept of liabilities in balance sheet, and those liabilities can become sometimes coming from like collateral based lending or the asset based lending. So I did not know about that, but I am coming across it multiple times. So I thought let's go into deep in what this stuff actually is and what does it actually mean. So here is a handbook PDF that I downloaded actually. And from I found this PDF using ChatGPT again. That I said that I work for this kind of a company and I want a PDF so that I can learn something better around this topic and do something around it, explain it in a better way. So what happened? Let's just start this book. What it talks about. So what is an asset-based lending? Is that, for example, you want to borrow some money from someone, but someone who is lending you money basically wants to have something so that to reduce the risk of default. So it is possible that you don't pay it back. So to secure it, it can take something from you. For example, it is very common that in banks, you go and you put your home something like a collateral and take a big loan, right? So that home that you're giving, that helps as an asset, is a collateral, right? And whenever a loan that is given on this kind of collateral based stuff, that is basically a asset based lending. So that is what we are going to talk about. So ABS is a specialized loan product that provides fully collateralized credit facilities to borrowers that may have higher leverage and erratic earnings or marginal cash flows. So these loans are based on assets pledged as collateral and are structured to provide a flexible source of working capital by monetizing the assets on the balance sheet. Monetizing means just that you are using the assets as a collateral to raise some money. That is what the whole point is. So while troubled companies often rely on ABL to provide turnaround. So yes, one thing, this turnaround thing, there's a new term that I learned and I did not know about that. So I asked ChatGPT, and this is what it say, that turnaround means that you are doing some restructure in your debt to equity part. So you're either you are increasing the debt or decreasing it or changing some part or shuffling some portion of debt and equity between them. So that is what the turnaround means. Then you come the debtor in possession, that is DIP financing. So DIP financing means that there's a company who is going to be bankrupt, and they just want to take some money and raise some money, and that is what debt and financing means. So in those cases, the ABL can be very helpful. Also used by healthy companies to see greater flexibility. It is not needed that the company should be bad or at a higher risk or something like that to get the lending. It is just that they some need more money to expand their business, and that is what it is all about. So the company can be in good condition as well to raise some debt. Basically, the primary source of repayment for the revolving is the conversion of the collateral to cash over the company's business cycle. So what happens that how the borrower is going to pay that lended amount, right? So that is only if their business is going well, they will generate some money and they will pay back. So that is what it is talking, that collateral gets converted to a cash, and that gets used as a like the repayment of the liability. The loan advances are limited to a percentage of eligible collateral, the borrowing base. So this is a new term. What it means that the bank is not going to give all the loan on all the collateral that you have. There will be some part of it on which it will agree that we will give money, right? So yes, so we were at the point that the banks will say that we can't lend all the money on based on all your collateral, because some of the money that we will give you may get to default, and according to that we are going to pay some percentage of the collateral, that will be the borrowing base on which we can actually lend you money. So strong controls and close monitoring are essential features of ABL, that you have to strongly control how you are spending, how you are taking, or how you are borrowing and paying down, so that because controls are needed, because it can go out of control as well, that they are not able to pay the money, or interest rates are also getting higher, and if the defaults are not actually getting monitored properly, then how the borrower will pay to the lender. And it is the responsibility from both the sides to take into account that the business goes on well, and close monitoring is also needed. Lenders may also provide term financing for borrowers. 1 second. Yes, so we were at the point when we were discussing about the collateral and how the ABL generally works. So let's go to the next point, that why asset-based lending, or what are the advantages of ABL, and why it is popular basically. So first is it provides ready cash to support liquidity needs, eliminating the need to wait for the collection of receivables. That at the current time, whenever the company wants to raise some money, they can just go and take some money. That's it. They don't have to wait that the receivables will be converted to the cash, and then those cash will be used again in the business. So that is what it is all about. Second is it provides important funding for the companies in cyclical or seasonal industries by providing liquidity during slow sale periods and periods of inventory build-up. Basically, whenever a company has some seasonal business basically, and they want to raise some money, they can go and have money quickly. That is all ABL is all about. So ABL provides rapidly growing companies the cash to fund growth or replenish internal capital used to fund growth by financing increases in receivables and inventory. So it can also help companies to give more loans, or expand or contribute to the more growth of a company. Then ABL facilities are typically underwritten with a limited number of financial covenants. The additional risk this poses to the bank is mitigated by conservative advance rates against liquid collateral, strong collateral controls, and frequent monitoring. So covenants is about that whenever a lender is giving any money, they are posing some criteria that should be met by the borrower to take or raise some money. For example, there are multiple kind of profitability or ratios, financial ratios. So those ratios can be raised or put as rules by the lender, that if the borrower are and comply with this rule or this criteria, then they will be able to lend some money. So that is the covenants part, or what is the meaning of a covenant. And advance rates is like we discussed, right, that the banks can't give loan on whole of the collateral. So whatever the percentage they agree or on which they can lend the money, that is the advance rate. It is kind of a percentage that you have. Then borrowing terms and repayment schedules generally provide more flexibility and be customized to fit the individual business requirements or business cycle. This point generally means that there are some terms of the loan. It is kind of a loan, right? So it also has some terms and repayment schedules that is also flexible so no need to that much worry on that basis. But ABL borrowers, this is a very strong point, that ABL borrowers in many cases can monitor availability on a daily basis, and they should do that, because they don't know, it can vary from company to company, and on what basis, what is the financial amount they are working with, or what is the scale they are working with. But it is the best practice actually to monitor it daily, so that you can take a strategic decision day by day and make it improve, make the prediction model improve, the borrowing based model. This is the first part of the video. We'll upload this, and then we'll discuss about the next part, that is the disadvantages of ABL. They don't have much disadvantage, but we'll talk about that. Bye.